Global stock markets traded with a mixed tone on the Friday as the investor weighed interest rate expectations, upcoming economic data, and the corporate earnings. The United States equities slipped across major benchmarks, while the Canada posted modest losses, and the Latin America markets also diverged, with Brazil showing resilience even as the Mexico and the Chile retreated. On the Wall Street front, the downturn was broad-based but relatively mild. The Dow Jones Industrial Average fell 171 points or 0.3% to close at 46,100. Also, the S&P 500, widely regarded as the best barometer of the US market, lost 18 points or 0.2%, finishing at 6,000. Also, the tech-heavy names also saw selling pressures high as the Nasdaq Composite declined 75.62 points or 0.33% to reach 22,497.86. The small cap stocks were hit harder, with the Russell 2000 sliding 0.92 to 2,400. Interestingly, despite the declines, the investors' nerve appeared steady as the CBOE Volatility Index or the VIX Index also slipped 72 points, suggesting that the traders that the viewing of the pullbacks are high as the profit taking rather than the deeper sell-offs are also seen. The Canada, the equity mirrored with the US trend but also with the softer losses. The S&P TSX Composite Index dropped 58.68 points or 0.2% to settle at 29,700, while the S&P TSX 60 edged down 0.1% to reach 1,700. The energy and the financial stocks dragged on the performance as the investors tracked oil prices movements and the global demand outlook. Elsewhere in the Americas, the market presented a mixed picture. The Brazil Bovespa index managed to buck the trend, inching higher by 66 points or 0.05% to reach 1,46,000. Also, the gains in commodity-linked sectors helped offset the global risk-off sentiment, in contrast with the Childe's S&P IPSA that fell 32 points or to the level of 9,114, while the Mexico's S&P BMV IPC suffered one of the sharper declines in the region, sinking to 462 points or to a level of 61,000. The divergence underscored how the country-specific factor from the industrial performance to consumer demand continues to shape market direction. Overall, the trading across the region was also marked by the caution. Investors are awaiting the US economic reports on inflation and jobs, which could also heavily influence the Federal Reserve monetary policy path. With the indices still near record highs, even the slight surprises in the economic data could swing the market sentiments quickly. Also, the analyst noted that the recent pullbacks are likely part of a natural pause following strong gains in the recent weeks rather than a shift towards prolonged weaknesses. Also, the macroeconomic data is what the key indicator that you should look before investing. For now, the volatility remains muted, suggesting that the investors are rushing to unwind positions but are also instead adjusting portfolios carefully in anticipation of the next market moving catalyst. The commodity markets traded mixed on the Friday, with the energy prices mostly lower, the metals showing slight weaknesses, and the agricultural products edging higher. The traders also balanced shifting the supply-demand dynamics, geopolitical considerations, and currency movement, while also keeping an eye on the broader economic outlook that also continues to influence the raw material demand. In the energy market front, the crude oil prices have slipped as the investors are reassessing the global demand prospect. WTI crude oil future fell $0.29 or 0.4% to settle at $64 per barrel, trading within the 52-week range of the $55 to $79. The Brent crude oil, the international benchmark, also eased, declining $0 to 68.22 per barrel dollar compared to its yearly range of $58. The analyst attributed the mild pullback to the concerns about slowing demand growth, particularly in the major consuming economies, through the supply discipline from the OPEC Plus members provided some support. The natural gas also bucked to $3.15 per million BTUs, with the prices moving between $2 to $4 over the past years. Stronger seasonal demand and tightening inventories gave the contract a modest boost. Talking about the precious metal sector, traded with little conviction, the investor awaited further signals from the central bank. The gold futures are virtually flat, that is, dipping just 0.2% to now $3,705 an ounce, and also holding near the upper end of their 52-week range. The silver slightly also slipped, reaching $44.15 an ounce after recently testing highs near $44. The market participants said that the metals complex is consolidating after sharp gains, with the safe haven demand steady but tempered by the strength in the US dollar. The agricultural commodities were also mixed but generally firmer. The soybean rose to $10 per bushel, supported by the steady export demand and concerns about the weather pattern affecting crop yield. The prices remain within relatively tight 52-week band of $9 to $10. The traders noted that while the fundamentals are stable, the soybean continued to be sensitive to the development in the global trade follow the climate landscape. Also, the uncertainty is mounting. The metal investors are taking a wait-and-see approach on the monetary policy and agriculture market, stabilizing on the supply concerns. Analysts say that in the near term, the macroeconomic signals, particularly the inflation data and the currency fluctuations, will also likely play a decisive role in shaping the prices momentum across the complex.